got some fantastic guests today. Our session is focusing primarily on the importance of industry data and how that affects NOI and asset valuations. We do genuinely have three brilliant perspectives today. We have Jan from an operator's perspective, Rose from an investor's perspective, and Parag, who is helping essentially rewrite the rule book. The format is quite simple. There'll be a short presentation from each guest, followed by a Q&A. So yeah, hopefully this will be a relaxed and insightful session. As Chanel said, if you have any questions, feel free to drop them into the chat, and we'll try and answer them as we go. If not, I'll make sure that I follow up after this with answers to all the questions. So our first guest today is Jan. Jan is the ESG manager for Europe for Mapletree. Jan sits on the ground floor of the data problem for Mapletree and manages Mapletree's ESG European portfolio, which means essentially that Jan is turning data and decisions at asset level every single day. What does genuinely good data look like to you on the ground? I'm thinking about things like reliability, what's actionable, and where do you see that from an operations point of view kind of fall short?
Yeah, so I think the issue is not usually the lack of data, but the reliability of the data. So we try to transition to as much to automated data linked to smart meters instead of like manual inputs, because usually you see that sometimes a kilowatt hour is mistaken by a gigajoule, or just it's megawatt hour instead of kilowatt hour, and then it's really up to the quality of the data review. But furthermore, also when you see that we have smart meters on site, a lot is automated, but you can also sometimes a meter goes offline, or an API template change, and out of a sudden the data that's on site is not correctly translated into our ESG data management platform. So it's really good data should really be reliable and accurate. So that you can compare assets with each other to see the outliers.
You talked earlier on about the change and the importance of moving to smart metering, for example, in order to obtain a kind of more granular level insight of kind of building performance. How much of that push for better data quality is coming from regulation versus your own operational targets, and does that change how Mapletree prioritize where you will invest capex, for example?
Yeah, well, I think it goes hand in hand. So you can definitely see that regulation gets tightened. Each country has a bit of different requirements, but overall you see it's tightening in all countries in the Europe and UK. But also from an operational perspective, it's very interesting to have that data, because you can really see the outliers and the properties that you should focus on. So yeah. I think there is a big drive from an operational perspective, because in the end, lowering utilities will have a lower operational cost. Furthermore, the legislation is also important. And also what we see is that investors and other stakeholders require more data. So where they previously looked more at policies and commitments, they now also want it to be evidenced with actual data.
If you could give kind of one piece of advice to I guess an operator, portfolio manager just starting out, who's taking their kind of asset data seriously, what would that advice be?
I think think about what you want to achieve. So what is your goal? Is that to drive utility consumption down, or is that to improve the comfort of your residents, or is there any other goal? So if you have that clear, you can well direct your actions towards it, and also determine what data you would need.
Rose Newton is the head of impact for Europe for Harrison Street. Rose, thanks very much for joining. Over the years, we've done a couple of these sessions together, so yeah, hopefully we're not repeating ourselves. But Rose looks, I guess ultimately Rose kind of looks at the same data from the other side of the table, or the other side of the coin, as an investor who's spent over a decade building one of the most rigorous ESG programs in real estate management. So Rose, that feels like a good introduction for you. You mentioned that Harrison Street have been running a kind of formal ESG program since 2013. That's way before most investors made it a priority. What I guess my question is, what did you see back then that others were missing? And has the conviction played out as you expected?
Yeah, so good question. Obviously, I can't take too much credit because I only joined the company 10 years after the program was implemented. However, what I would say is that, sort of as I alluded to into the introduction, we've always looked at ESG in terms of outcomes and impact, rather than trying to think of it, or thinking of it more as a sort of onerous or bureaucratic sort of compliance burden. So we've always tried to think of it as an opportunity to create value, and looking at it in that light, it's obviously a lot more attractive perspective from an investor's point of view. So I'd say that's one of the drivers. I'd also say the fact that we invest in these alternative sectors. So these are sort of needs-based, deliberately sort of demographic-driven assets. And actually, a lot of the ESG factors align with these value drivers, with value drivers in these sectors anyway. So, for example, you've got your senior living. People are always going to get older. We're always going to need those facilities. Student housing, people are always going to send their children to school.
Yeah.
So these buildings, we're invested in design for the long term. They need to be resilient. They need to be future proof. And one of the biggest threats to the built environment in terms of future proofing is climate risk, both physical and in respect of compliance. So, and then similarly, from a sort of social perspective, using the student and senior living examples again, these are two of the loneliest demographics we know from studies. They're also two groups that could potentially benefit the most from social programming. So again, I would say, generally, regardless, certain ESG factors are always material, but in terms of the specific product that we produce, I think ESG factors are particularly pertinent, both from an environment and social perspective. And like I said, even more so, we can kind of use that and feed into our thesis that there's sort of value to be captured there. How well has that been borne out? I mean, good question. Like I said, I think it's always beneficial to be ahead of sort of regulation, and prepared from kind of, like I said, a sort of resilience point of view. But we have also been working on this kind of value creation product or project. So I think to some extent we've been able to validate that side of the equation as well, and show, like I said, that this isn't just sort of risk management, but hopefully actually supporting returns and our overall investment strategy.
What does an investor or kind of lending partner actually want to see from a kind of data perspective? And has that bar been rising?
Yeah, no, definitely. I think previously they were happy to sort of just look at sort of the high level results, for example, the results of things like GRESB, whereas now they kind of want that underlying asset level data to understand what we're feeding into it, so that they can use it with potentially their own tools, and like I said, with their own sort of analytical models or whatever that they've been building out internally. I think we're a little bit cautious in terms of how much data we provide to them. Obviously, we consider ourselves to be managers. We don't know how sophisticated their teams are. We're obviously like to think we bring a lot of experience and expertise to that. And if we don't know exactly how that data's going to be used, we're not sure how valuable it will be to have too many people in the conversation around strategy necessarily. So I think we are a little bit cautious of that. But in terms of things that they're asking about, I would kind of, and you mentioned borrowers as well as sort of investors, I would definitely say that the ground between value add and compliance is constantly being eroded. So many items which were kind of gold standard and would maybe command a higher price or a lower sort of borrowing rate are shifting more towards business as usual. So rather than necessarily commanding a premium, in some instances you can't sell an asset or you can't get a loan on an asset without a certain EPC or without a green certification. So it's a lot about sort of preserving value as well. But I would definitely say it's become a lot more onerous in terms of data requests.
And is that Parag is our next guest, and I'd like to make sure I give him enough airtime. Parag is the Director of Real Estate Analytics for GRESB. I guess for want of a better phrase, Parag, you kind of sit above all of this, not just from a benchmarking across thousands of assets globally, but you're currently co-authoring the framework that will define what kind of good looks like over the next 10 years. So yeah, can you just quickly summarize what's actually changing and kind of more importantly why now?
Right. So I'll maybe sort of answer them backwards. Why now? Because our stakeholders asked us to do so, right? We realized what is missing in the assessment. We talked to our stakeholders who are investors and participants and financial institutions and own managers, and we arrived at this consensus that okay, the era of disclosure being sustainability is kind of coming to a close, and we need to move to a new era of performance is sustainability, measured performance. And that's just it's a development it's a reflection of the maturity and the change in maturity of our thinking, but also just like what we can actually measure over time has improved. Smart meters were a novelty 20 years ago, but now they're kind of just accepted, right? And what's to your point about what's actually changing currently, pure performance is about 12% of the points. There's a few proxies like building certifications that make up another about 10%. Yeah. And then we have data coverage is about 20%. All of that and more is going to be just pure performance from 2028 onwards, right? So we are now going to have predictable changes, 3-year, communicated several years in advance, so you can plan for them. And tranche by tranche, we're moving towards addressing different aspects of performance, starting with energy and emissions in 2028, in the 2028 update, which will be published this year. Because in real estate, 2028 is tomorrow, essentially. So you have to publish it now, right?
From the kind of current framework, what that rewards kind of strong management process and kind of data reporting. The new kind of performance framework that shifts the emphasis towards kind of actual measured outcomes from what you've mentioned. How big a change is that in practice, and I guess what does that mean for operators and how they need to think about the data that they collect and report upwards on?
Yeah, it's an interesting question because if the performance component makes up 50 to 75% of points, right, of pure performance, then how does management practice still play a role? So, okay, literally, you were getting rewarded for getting points for management performance, and now that's considered fundamental. So it's more of you just have to have it, right? But practically, what we have found, including in 2 papers that we did with INREV and ANREV, is that good scores in GRESB usually correlate with good financial returns because of good management practices, right? There's no causation, obviously, right? But it's more the fact that they both come from good management practices. So as an example, if we publish that, hey, energy efficiency and combustion avoidance and renewable energy are important in 2026, and we'll be assessing this in 2028. If this is the first time you're thinking about energy efficiency, I don't think that's good management practice necessarily. So the people who already have good management practices in place and have been thinking about them and have so far been, thinking only about sort of like been assessed only on the disclosure part, will now move towards performance.
Yeah.
But the fact that you're managing your buildings well should do you well in the new regime as well, right?
The last question I've got, I guess, is for the kind of people on this call, kind of operators and asset managers, who are still building their data foundation and hearing about the changes that are coming to the framework. Where would you say the most important place for them to start is, and what does good look like?
Well, if you don't currently collect data from your asset, you should probably start there, right? I don't, there's this sort of adage that's used a lot. If you can't measure it, you can't control it, right? I'm sort of paraphrasing. So it'll be hard to, you can imagine from the perspective of GRESB, which has to be globally applicable across all sectors, all geographies. We do have to sort of hang our hat on something that is consistent and reliable globally. And for us, that's, meter data and floor area, just things that are both collected for GRESB as well as other things like transactions and continuous management. So realistically, if you're looking at an asset and trying to improve its value, not just to the investor, but also to the occupiers, you're kind of doing what GRESB expects you to do, which is just manage the asset well. And the only extra layer that GRESB adds is now there's an external verification and benchmarking exercise, and the score is just a reflection of how well you're doing against absolute markers of efficiency and carbon, so that you have an idea of where, like somebody looking at this data from outside the asset has an idea of where this asset stands, right? Because that's valuable to know in terms of planning. Am I consume, I don't know, I'll just take a number, 100 kilowatt hours per meter square. Is that good? Is that bad for my geography, for my sector? But you don't know until you go to GRESB. But the fact that you first have to know how much your asset consumes, there are actions you can take that have nothing to do with GRESB, right? Like you can't argue against like decarbonization. It's hard to argue against that.
Yeah.
It will lead to a great outcome in GRESB, but that's not why you would do it. You do it because you want to make your asset more valuable and because it's more efficient, or because it doesn't have transition risk and physical climate risk has been taken care of. So I would say the starting point is really what it has always been. Operate and manage your asset better, invest in it to reposition it, and the GRESB outcome will follow.